Let's talk about a question that sounds so simple, you probably think you already know the answer. What exactly is money? I mean, you use it every single day, but what it really is, and more importantly, where it comes from, well, that's one of the most surprising stories you'll ever hear. So let's dive right in.
Okay, let's kick things off with a little trivia. What do you think was the most widespread and longest-lasting form of money in all of human history? Go ahead, take a guess. If you're thinking gold, maybe silver, you're in for a shock. The answer? The cowrie shell. Yup, these little shells. For thousands of years, across huge parts of Africa, Asia, and even into Europe, these were the go-to currency. And when you think about it, they were kind of perfect. They were super durable, they were easy to count, and best of all, you couldn't just fake them. And the story of the cowrie shell gives us our first huge clue in this mystery. See, it tells us that money isn't about what it's made of, it's about what it does. And it turns out money has four very specific, very important jobs. Now, to really get why these jobs are so critical, you have to imagine a world with no money at all, a barter system. It's a total mess. For anything to happen, you need what economists call a double coincidence of wants. So if you're a web designer and you want a pizza, you literally have to find a pizza chef who needs a new website right now. It's just so inefficient, it basically grinds an economy to a halt. So this brings us to money's number one job, to be a medium of exchange. It's the go-between. It's the thing everybody agrees to accept. That web designer can just get paid in money and then go buy a pizza from anyone, anytime. It just works. It lets the whole economy breathe. Okay, job number two, money has to be a store of value. Think about it. You can't really trade in strawberries, right? If you tried to save them up for 6 months to buy a new car, you just have a pile of mush. Money, on the other hand, holds its value. It lets you save up your work from today to spend it tomorrow or next year. And job number three, money is a unit of account. It's like a universal ruler for measuring value. Without it, you get these ridiculous questions like, okay, how many pizzas is one car worth? It's chaotic. With money, everything just gets a price tag. It makes comparing value and making choices a million times easier. And finally, the fourth job. It's a standard of deferred payment. Now, this one sounds a little technical, but it's huge. This is what makes things like loans, salaries, and contracts possible. We can agree today that you'll pay me $1,000 in 6 months because we both trust that the value of that dollar will be relatively stable. So basically, anything that can do those four jobs can work as money. But wait a second, that leads us to a brand new puzzle. That paper bill in your wallet, it's not really durable, you can't eat it, so what in the world gives it value? To answer that, we gotta look at how money evolved. For a really long time, most money was commodity-backed. A dollar bill wasn't just a piece of paper, it was basically a claim check. You could, in theory, walk into a bank and trade it for a specific amount of gold or silver, but that's not what we have today. Today, we use what's called fiat money. It has zero intrinsic value. It's not backed by anything physical at all. So if it's not backed by gold, what's backing it? Well, just pull a dollar out of your pocket. The answer is printed right on it. That little sentence, that's it. It's a declaration from the government. The value of our money comes from that government promise, and from our collective, shared belief that other people will accept it as payment. That's it. It's an economy built on trust. But hold on, the rabbit hole goes even deeper, because it turns out most of the money we use every day isn't even those physical paper notes. And to understand why, you have to see how economists actually count all the money out there. Right, so economists have these categories for measuring the money supply. The main one is called M1. Think of M1 as all the super liquid, easily spendable money. That's the physical cash in our wallets, plus all the money sitting in our checking and savings accounts. And as you can see, those deposits, they're a huge chunk of the pie. There's also M2, which is just M1 plus some less liquid stuff like CDs. Now, let's put some real numbers on this. Back in late 2021, the total amount of physical cash, actual bills, and coins in the US was about $2 trillion. But the total M1 money supply? Over 20 trillion. Let that sink in. The overwhelming majority of what we call money isn't cash. It's just digital entries in bank computers. So if most money is just numbers in a bank account, and the government isn't just typing those numbers in, where does it all come from? This, my friends, brings us to the most incredible and, frankly, misunderstood part of modern economics, the fact that commercial banks literally create money out of thin air. And the secret to how they do this is a system called fractional reserve banking. The rule is actually pretty simple. When you deposit money, the bank is only required to keep a small fraction of it on hand, in reserve. Let's just use 10% for our example. They are then legally allowed to lend out the other 90%.
So let's see how this magic trick works. Imagine you deposit $10,000 into Bank A. The bank holds on to 10%, so $1,000, and then it loans out the other $9,000 to someone else. Now that person takes the loan and deposits it into Bank B. And here's where the magic happens. Bank B does the exact same thing. It holds 10%, $900, and loans out the rest, $8,100. That loan gets deposited somewhere else, and the cycle just keeps repeating, creating a massive ripple effect of new money throughout the economy.
Now this chain reaction, it's not random. You can actually predict it. There's a formula called the money multiplier. You just take 1 and divide it by that reserve ratio. So in our example, it's 1 divided by 10%, or 0.1, which gives us a multiplier of 10. So what does that multiplier of 10 actually mean? It means that the bank's initial ability to lend out that first $9,000 can, by the time the whole process is finished, create up to $90,000 in brand new money. That's not moving money around. That is creating new money. That is the incredible power of our banking system. So there you have it. The mystery is solved. Most money isn't printed by a government. It is lent into existence by regular commercial banks. This system is the engine of our modern world. It's unbelievably powerful, but it's also walking on a tightrope. On the one hand, the upside is huge. This is how businesses get the capital to grow, how people get mortgages to buy homes. It fuels everything. But on the other hand, the whole thing is built on confidence. If too many people start defaulting on their loans at once, like with the subprime mortgages back in 2008, that confidence can shatter and the entire system can seize up. The fundamental risk is that banks are borrowing short-term, your deposits, which you can ask for at any time, and lending long-term, like a 30-year mortgage. If everyone wants their money back at once, the bank just doesn't have it. So think about this journey. We went from a physical shell that was valuable because you couldn't fake it, all the way to a global system where money is just digital information, created out of thin air by a promise to repay a loan. What this proves is that money isn't really a thing, it's a technology, and that technology is always changing. So as we see things like cryptocurrency start to emerge, things that don't need banks or governments, you have to wonder, are we about to witness the next great evolution of money?